Hello, everybody. This is a synopsis of Chapter 3 for Finance 302. And this chapter is on financial statements. And so we're going to be looking at all of the financial statements, which hopefully are a review for you since you've had accounting before, since that's a prereq for this class. But we'll be going over the financial statements in preparation for the next chapter. In chapter 4, when we go over the ratios, we're going to be following the same company for the next two chapters. So in accounting, they teach you how to prepare these financial statements. In finance, of course, we're dealing mostly with the analyzation of the financial statements and of the ratios. So I don't cover the tax section in this class. So if you make sure you look at the reading assignments before you tackle each chapter. So in this particular case, we're going to be stopping prior to the section on taxes. All right, so let's dive right into the information here. Okay, so what's in an annual report? These are the 4 financial statements that are in an annual report. A balance sheet. A balance sheet tells us what the company owns on the left-hand side, and then what they owe on the right-hand side. And so if you take what they own on the left-hand side, that's going to equal what they owe on the right-hand side. And then also remember, on the right-hand side is liabilities, what they owe, plus the stockholders' equity. So liabilities plus the owner's equity equals the assets. Or another way to think about that is assets minus liabilities equals the owner's equity. So if you take all their assets and you subtract out their liabilities, you're left with what the owners, the equity that the shareholders have. Also, you can think about a balance sheet from a personal financial planning perspective. Forget about a company. What if you listed everything that you owned? Well, if you apply for a loan, a company is going to ask you, what your assets are. They're going to ask you what you owe on a monthly basis, income coming in, and they try to ascertain what your assets are. They're basically trying to figure out your net worth. So if you think about the balance sheet from a personal perspective, you would, on the left-hand side, you would list what you own, your car, maybe some bank accounts, some personal property, a house if you own a house. List everything that you own. On the right-hand side, you're going to list everything that you owe. How much, what's your mortgage? If you have an auto loan, if you have student loans, credit cards. So you list everything, all the debt that you have. And if the difference between the two is your net worth. So most of us, hopefully we all have a positive net worth. What we own minus what we owe is our net worth. That should be positive. But you can see how, for example, during the last financial crisis, we had that recession, 2007 to 2009. Think about if you had a house and it went down by 50%. That happened in some markets. That easily put people into the negative net worth category. So anyway, balance sheet, think of it, it's a snapshot in time. You can think of it from a corporate perspective or from a personal perspective. Okay, moving on now, income statement. The income statement summarizes the firm's revenues and expenses over a period of time. So whereas the balance sheet is a snapshot at the end of the calendar year or the end of the fiscal year, if they're using a fiscal year, the income statement summarizes their revenues and their expenses over the course of a calendar year or a fiscal year. A lot of companies have a fiscal year that may end on September 30th or October 30th. But some have the calendar year. All right. So if you recall from accounting, you probably learned about accrual accounting versus cash accounting. With cash accounting, if you had a small business, let's say you had a tutoring business or a landscaping business, whenever you made a sale, you book that cash. In other words, whenever you made a sale, you got the cash right away. So you're counting all that immediately. Most businesses don't go on a cash basis. If you were on a cash basis and you prepared your income statement, your net income would be the cash that you have on hand. But in business, most companies go by an accrual system where they might book a sale. Let's say you book a sale in December, but you may not get the cash for a few months. So we have accounts receivables and we have accounts payables. So because of that, and also companies depreciate their fixed assets. The depreciation is an expense on the income statement, but they're not really paying that money out. It's a non-cash expense. So because of the accrual system and also because of depreciation for one, the net income that a company reports on their income statement, that has nothing to do with the amount of cash that they have. They could have more cash than the net income. That is saying they could have less cash depending on what's going on. So that's the reason why we have this statement of cash flows. The statement of cash flows shows how much cash the company has after they've bought any capital equipment that they're going to buy and so forth. So we're going to go through that cash flow statement also after the income statement. And then the fourth statement, not as important as, I would say, these two, balance sheet and income statement, are the most important, followed by the cash flow statement and then statement of stockholders' equity. That just shows how much of the earnings were retained and how much of the earnings were paid out as dividends. Because remember, with an income statement, when you get to the net income, there's two things that a firm does with the net income. If they pay a dividend, they're going to use their net income to make a dividend payment. And then all the rest of the money that's left over goes into retained earnings. All right, so we're going to be talking about this company called De Leon. They have undergone an expansion, and it hasn't worked out for them yet. So we're going to see what happens in the next chapter. But they've undergone this expansion, and their numbers, their financials look kind of bad. And then we'll be looking at this company throughout the next two chapters. Okay, so let's take a look at their balance sheet. So remember, on a balance sheet, we have current assets, fixed assets, and then that brings us to our total assets. So their cash is money that a company has in a checking account. That's the cash that they're going to need for the next year. So it's short-term needs for that. Sometimes you'll see something under this called marketable securities. Marketable securities are just like a checking account, but you will earn a little bit more interest with marketable securities because they're buying short-term debt instruments like short-term government bonds. So you can earn a little bit more interest, but it's considered cash also. So if you see marketable securities under cash, it's the same as cash. Accounts receivables, that's money that's due from customers. So the customers have purchased goods and services, but they haven't paid yet. And that's what they're expecting to get from their customers. So you see their cash has gone way down. They've used that to fund an expansion. Accounts receivables are way up. This could be because their sales have increased and or because it's just taking them longer to get payment from their customers. Okay, inventories, self-explanatory. They've had this expansion, so they've increased their inventories, and that's right here. So current assets are short-term assets used within the next year. Assets we're looking at for the next 12 months. There's the total current assets. Then we have fixed assets. Sometimes you'll see this as plant and equipment and land. This is a real simple balance sheet, so they just have it totaled here. But fixed assets would be factories, so plant and equipment. Sometimes you see land, as I said, separated out. Those would be examples of fixed assets. Assets that the company is going to have for longer than 1 year. And in this particular balance sheet, they've subtracted out the depreciation and given us the net fixed assets. So here we have the total assets. This number has to equal our liabilities and owner's equity on the other side of the balance sheet. All right, here's the other side. So we have accounts payable. Accounts payable is money that we owe to our suppliers. So we've purchased things from our suppliers, and this is what we owe them. that's increased because of the expansion. Accruals, that's increased also. Accruals are money that we have set aside that we know we have to pay sometime this year. Taxes, salaries would be examples of accruals. Notes payable, that's debt that is coming due this year. So either a loan that's coming due this year or bonds that you've issued that are coming due this year. So these are our current liabilities. All of our bills that are due this year, current liabilities. After that, we have long-term debt. That's loans or bonds that are coming due in a term greater than 1 year. Okay, and then we have, so we have our current liabilities here, long-term debt, and then these two portions are equity. The common stock, this is the book value of the common stock that's been issued, and then these are retained earnings. So you see that in order to fund this expansion, they've increased their debt, and they have used a lot of their retained earnings, almost 200,000 of retained earnings. This is in millions, but anyway, to make it easier, I'm just saying 200,000. Okay, so you add all this up and you've got the total liabilities and owner's equity. So what they've done here is a little confusing. They've added these two numbers together to get the total equity right here. But actually, these are the total current liabilities. So if you have this number plus this one, plus this one, plus this one, you're going to get the 2866,592. Or this number plus this number plus this little subtotal of the equity, which is these two numbers, you get the same answer. Okay, so that's the balance sheet. Let's move on to the income statement. Okay, now this, I'm going to tell you a little bit. Oh, wait a second. Okay, when you look at this, look down here, and because I made a correction, not a correction, but I made a revision here to make it a little bit easier to read. So what they did here was well, let me just start by explaining the income statement, then I'll get to this part down here. So they have, let me see if I can get rid of this so you can see it. Hang on a second. There we go. Okay, so right here is the sales, okay? Then you subtract cost of goods sold. So you have your sales minus cost of goods sold, all of the costs associated with selling your product or your service. Then you have other expenses, administrative expenses or what have you. Okay, now you see what they did here? They have totaled up these expenses and given us this number here. Just forget about that. What you should have right here is called EBITDA. So you have your sales, okay, minus your total operating costs, which is cost of goods sold and other expenses. So if you take this number minus this number minus this number, right here you should have, it should say EBITDA, and it should be 78,808. So you can, if you're going to make some notes on these, if you've printed these out, get rid of this and put EBITDA right here and put 78,808 right here. Well, actually, yeah, that's fine. Put 78,808 right here. All right. So what is that? What is EBITDA? Well, EBITDA is earnings. That should be a B right here. Hang on. That should be, so EBITDA, EBITDA. What does that stand for? Earnings before interest, taxes, depreciation, and amortization. And so you see here we have EBITDA. Here we have EBIT, earnings before interest and taxes. Here we have earnings before taxes. So if you follow this example that I'm giving you, it'll be really easy for you to remember what comprises an income statement. Sales minus your cost of goods sold minus any administrative or other expenses leaves you with EBITDA, earnings before interest, taxes, depreciation, and amortization. Okay. Then you know what to, if you have that, then it's kind of a guide to tell you what comes next. So amortization, depreciation, amortization. Depreciation is self-explanatory. Amortization is if a company leases equipment, you have the rental as the amortization. So that's what that means. So after your EBITDA, the next thing that comes out is depreciation. So we have depreciation here. So we have the 78,808, that should be here, minus the 116,960, and we end up with negative 38,152. That's EBIT. You see, we just dropped off the D and the A, earnings before interest and taxes. Then we take out our interest expense. Okay. Then we have our earnings before taxes. We take out our taxes, and then we have our net income. So in this situation, it's negative because they had a loss here. But let's go to 2018. So if you took this number minus this number minus this number, you're going to get your EBITDA. Okay, then you subtract the depreciation, you get 190,000. Subtract your interest, you get 146,600. Subtract taxes, and you get 109,950. And so this is a very simple income statement to show you the main features of an income statement. Okay, so you'll notice here this depreciation. Here, I mean, he didn't have much here, but they bought a lot of equipment for this expansion. So this is a pretty large number for depreciation. That's added back in the cash flow statement because you're not really paying that. That's a non-cash expense. So they probably didn't really lose this much money. I mean, this is their net income, but that doesn't mean they have negative 160,000 in cash. Okay, let's go on to the next slide. Okay, here's some other data. The number of shares outstanding, 100,000. Earnings per share, that's the net income divided by the 100,000. The earnings, so the net income divided by 100,000, that's how you get this earnings per share number. Dividends per share is their dividends divided by the number of dividends paid divided by the number of shares outstanding. Here's what the stock price actually was in 2018 and 2019. So you see the stock price has gone down quite a bit. Investors aren't really happy with what's going on with the financials or what's going on with the company with this expansion. So of course, the $1 million question or the $100,000 question is, should you be a buyer of this stock? Would you be a buyer of this stock right here? And there's really no right or wrong answer. It just depends on what you think is going to happen. Some people would say, no, it's probably a falling knife, so to speak. It's going to continue to go down. But other people would say, hey, this is a real sell-off considering, they've undertaken this expansion. Maybe they can turn things around. It's, probably Wall Street is a little bit premature in this sell-off and maybe it's a good buy. So if, this is what investors love to do, to get it to say, oh, well, it's to find something that's undervalued and is a good buy and is going to go up. So anyway, it's a crapshoot since we can't predict the future. But I would say, I would probably, if this company was viable, if it was a dead business, I might not buy it. But if they have products that I think people are going to want to continue to buy, probably it's undervalued. Okay, and then there's their lease payments. And by the way, we're going to see in the next chapter what the analysts think is going to happen, and they do think that it's going to go up. So I had that information, of course, 2020 hindsight. So I would be a buyer of this because it looks like the analysts do think it's going to go up next year. You'll see that in the next chapter. Okay, statement of stockholders' equity. So this is just this is how many shares of stock they have. This is the book value of the stock. These are the retained earnings. So if you go to the 2009, if you go to at the beginning of the year, if you go to the last year's balance sheet, the retained earnings are here. This shows you how you calculate the new retained earnings. So it's a real simple formula. You simply take the retained earnings last year. You would add in the net income, which in this case it's negative. You subtract out any dividends paid, and then that gives you your ending balance of your retained earnings. And that's, if you recall, that's the cash that, that's the retained earnings that they had in on the balance sheet for 2019. This was 2018, this was 2019. And then this was the total stockholders' equity for 2018 and 2019. What this number is these two numbers here. Okay, let's look at the statement of cash flows. Now there's three parts to the statement of cash flows: operating activities, investing activities, and financing activities. This is just telling us where the money has gone. And so this can be a little bit confusing, but this is the way to think of these cash flows. Think of the assets. Any increase in assets is going to be a cash outflow. So if you think about it, if you bought more inventory, your inventory would increase, right? So that's an asset. If you increase, so right here, they've increased their inventories. If you go back and look at the balance sheet and you take the difference between the 2 years inventories, this is the number. So they purchased an additional $572,000 in inventory. The inventory increased, so that's a cash outflow. They had to purchase that. Their accounts receivable increased. That's an outflow, okay? Now on the liability side, it's just the opposite. If you have an increase in accounts payable, that's money that you haven't paid out yet. Yeah, exactly. An increase in accounts payable, that's money that you owe. So just think about it in this way. If you got a new student loan at the beginning of the semester, that's a liability that's increasing to you, but that's a cash inflow because that's money that you're getting. So let me back up. On the asset side, any increase in an asset is a cash outflow. A decrease in an asset would be an inflow because you would be selling off things. Just the opposite on the liability side. An increase in a liability is a cash inflow. A decrease in a liability would be a cash outflow. So accounts receivable increased, that's an asset, it's negative, it's an outflow. Inventories increased, that's an asset, that's a negative, it's an outflow. Our accruals increased, you go back to the current liabilities on the balance sheet, that's an inflow. Our accounts payable increased, current liability, that is an inflow. And then we add the depreciation. So I know I kind of did this backwards. So with your operating activities, you start with your net income and then you add depreciation because that's a non-cash expense. That's an inflow. So you take your net income, you add depreciation, and then you look at these things and you look at your current liabilities, your accounts payable, your accruals, your receivables, and your inventories. And you see, you look and see if they've increased or decreased. And then that tells you if that's an inflow or an outflow. So go back, study this and go back and look at the balance sheet and you can figure out all these numbers. These are the operating activities. So what happened here? The net cash provided by the operating activities, negative $164,000. So that's a negative, an outflow. Okay, next we're going to go to the investing activities. Now for this, you look at additions to the fixed assets. So to get this $711,750, we're going to go back to the balance sheet. And if you take, you're going to find the difference between these two numbers, the gross fixed asset, the gross fixed assets. That's how they're getting that number. So if you take $1,202,950 minus 491, that's $711,950. So for investing activities, they invested an additional $711,000 in fixed assets. So that's how they got that number. So let's go back to that right here. Okay, so that's additions to their fixed assets. That we just had one line there, but some in more complicated financial statements, they might have land, they have plant and equipment or land. So any additions to fixed assets are included here. So that's a negative because they purchased additional fixed assets. Okay, finally we have, Finally, we have financing activities. That is dividends and that is debt. So you look at, first you look at the notes payable. That's the current, that's in the current liabilities. That's debt that's coming due this year. So their notes payable increased. They got more financing. So that's a cash inflow. Their long-term debt increased. So that's an inflow. And then they did pay out dividends. They paid out dividends of $11,000. So we net this out, this plus this minus this, we have 825,000. Okay, so now we're going to take the net of these three activities. So we're going to take negative 164, 176, plus a negative 711, 950, plus 825, 808, and we end up with negative 50,318. So that's our decrease in cash. And then when you go back at the balance sheet and you look at the cash at the beginning of the year, and if you net this difference out, that's how you get your cash at the end of the year. And that is, that's what you put on your balance sheet in cash. So that's your cash flow statement. Okay, so this is just, you can read this on your own. This is just, they're just drawing some conclusions after looking at these financial statements. Okay, now we're going to talk about some other things. We're going to figure out something called the free cash flow. And the free cash flow is the money that's available to shareholders after the company has basically made all their capital purchases and so forth. And so we just looked at the cash flows here. We did this cash flow statement, but the free cash flow is something different. The free cash flow is the money that's available to shareholders after the company has made all the capital purchases that they're going to do. Then whatever's left over, that's called the free cash flow. And that's the cash that potentially would be available to shareholders. And so we need some of these calculations to figure that out. So the first thing we're going to calculate is net working capital and net operating working capital. Okay, so the net working capital is simply current assets minus current liabilities. That's the capital that they have in the short term. Net operating working capital excludes the notes payable. It excludes anything from financing activities, and that would be the notes payable. So the net operating working capital is going to be the current assets minus, you can just kind of discard this excess cash that you don't usually see that. But so it's going to be current assets minus current liabilities minus the notes payable, because you're excluding the notes payable. Okay, so let's calculate. Oh wait, they're going to show us an example of that down the road. Okay, next we're going to calculate their after-tax operating income. The way to calculate that, the after-tax operating income is simply the earnings before interest and taxes times 1 minus the tax rate. So their after-tax operating income is 142,821 in 2018. Here it is in 2019. Okay, this is all leading up to the free cash flow formula. Okay, so, and this is the net operating working capital for this company. So they're taking the current assets minus excess cash. So they're just taking the cash that's on the balance sheet and subtracting that out. And then they're subtracting the current liabilities minus the notes payable. So this is the net operating working capital for 90576. It's 905,760 for 2019. Here it is in 2018. Okay. 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 Okay, good. Okay, sorry about that interruption. Okay, so this is just an assessment of the effect of their expansion. So they're just showing how their sales almost doubled. Their working capital increased, but they went from making 109 million to losing 160 million. That's probably why the stock's down. Okay, here's the free cash flow formula. So the free cash flow formula, free cash flows equals the after-tax, let me go back to that. That's the after-tax operating income. Okay, so it's the after-tax operating income plus depreciation minus any capital expenditures plus the change in the net operating working capital. Okay, so think about this, just forget about the math and just think about it. Try to think about the big picture. What does this actually mean? Well, we're taking their operating income, okay, so their income from operations, and we're adding depreciation because they never had to pay that. That's a non-cash expense. So we've got their operating income plus depreciation, and then we're subtracting out the money that they've spent on capital. So they spent money on plant and equipment, and then they also increased their net operating working capital. So basically, this is the money that they had from their operations, and then this is what they spent. What's left, the net of that, is the free cash flow, which is what's available to shareholders. Okay, so how are we calculating this? Okay, so for 2000, they're just calculating it here on the slides for 2019. You can, as practice, I would recommend going back and doing it for 2018 and to see, just to see if you can do it on your own. Okay, so for 2019, the earnings before interest and taxes is negative 38,152. That's from the income statement. Somewhere it tells us that the tax rate's 25%. So times 1 minus the tax rate, okay, plus depreciation. And then we're going to subtract out what they spent on capital expenditures. That's the difference in the fixed assets. So you've got the $1,000,002 minus the 491. So that's that 711,750 number. So you take, these are their fixed assets from one year to the next. Now, let me give you a hint here. You have to take the gross fixed assets. So let me go back. Let me go back and show you something with the, in the balance sheet. Okay, to get the capital expenditures, we are looking at the gross fixed assets, these two numbers, and taking the difference. Now, sometimes companies don't give you that. They'll give you the net fixed assets. If they give you the net fixed assets only, then you have to take the difference between the net fixed assets and you have to add depreciation back. Okay, so just to repeat, if you have the gross fixed assets, fine, you just take the difference. In the homework problem that I know in this chapter, there's a homework problem where you're calculating the free cash flows, and you have to they just give you the net fixed assets. So in that case, you got to take the difference between the net fixed assets, but don't forget to add back depreciation. Otherwise, it'll be wrong. All right, so let's go back to the free cash flows. Okay, so so we're taking the difference in the gross fixed assets plus the change in the net operating working capital. Okay, that was right here. We calculated the net operating working capital for both years, and we're going to take the difference. That's the number right here. Okay, so that's how you get the free cash flow. So in 2000, if you go back and calculate it for 2018, you'll see that it's positive. Here it's negative. Now, they ask, is a negative free cash flow always a bad sign? And the answer is no, because a negative free cash flow means that the company probably has a negative free cash flow because they've done this expansion. They have all these capital expenditures. So if a company is expanding and has a long-term outlook, they're expanding for future profits, negative free cash flow for a year or two isn't necessarily seen as a bad sign. In fact, it can be considered a positive sign. So, so it's not always a bad sign. But if it goes on for years and years, then investors are going to get impatient, and then it can be viewed as a bad sign. Okay, here's a couple other performance measures. And these are really interesting because these performance measures look at the actual stock price, which those others, all these none of these financial statements really look at what's the going rate of the stock, what's the stock selling at. So one is called the market value added, and it's simply the current price of the stock times the number of shares minus the book value. Let me see if they have an example. Yeah, they did do an example there. Okay. And then we'll get to that in a second. And then the economic value is trying to find what's the true economic value, what's the true economic profit for a given year. So basically what they're doing is they're just looking at what the company's profit was, and they're subtracting out how much the money cost them. So if the profit was, if the profit was a certain amount, but it costs them more to borrow the money, or to if their cost of capital is higher than what their profits are, then they haven't added value for the firm. So the economic value added, here's the formula for it. It's the after-tax operating income minus how much capital they had to put in, total invested capital, times the cost of that capital. And so if you're making more money than the money's costing you, than what it's costing you to do business, then you have economic value added. Okay, so let's look at an example for the MVA. I don't think they have an EVA example in here, but let's look at the MVA. Okay, so here's the market value added for 2018. Remember, I think it was right after the income statement, they had additional information, and they told us that the stock was selling for $8.50. $8.50 times 100,000 minus the book value of the equity. That's taken from the owner's equity side of the balance sheet. So the company has added 186,232. But this changed dramatically in 2019. Now the stock price is only 225. So you take the 225 times 100,000 minus the book value of the equity, and you get negative 267. So so this is like I said, this is a metric that takes into account the current price of the stock. So all this shareholder wealth has been destroyed. Basically $400,000 in shareholder wealth has been destroyed, roughly, because it went from up 186 to down 267. Or, in millions, it's 400 million. All right. Okay, and then the rest of this you can just read on your own. They're just doing some analysis of some different things in those financial statements. But that is all I went. So we're skipping this part. So those are the main points in the chapter that you could have some issues, some problems with trying to read it on your own. Or if you're taking the class online, hopefully this helps you. If you're taking the class face-to-face, I'm posting these for you too, so you can just look at these as a just to help, because it's hard to sometimes hear everything in class and absorb everything in class. All right, take care, and I will see you next time when we discuss chapter 4, which is ratios.